Good morning, everyone. This is Marshall Giller bringing you the morning comment for March 18th. This morning, I'd just like to say a few last words about the FOMC meeting. As I said before, I still expect the FOMC to remove the reference to patient in the statement. Not necessarily because they want to raise rates immediately, but rather because they want to have the option to raise rates. Chair Yellen and her colleagues would like the decision to be driven by the data, not by their views, and so they want to cut themselves free of the forward guidance that they themselves put into place in order to convince the market that they were serious about keeping rates low. Now, this view of mine is probably consensus by now. So if they don't remove the line, then the dollar is likely to fall sharply. Will the statement mention the dollar? The dollar was not a big topic of discussion at the January meeting, according to the minutes. The U.S. is basically driven by domestic demand, not by exports. Yellen isn't likely to say anything about the dollar's value or the currency wars. The dollar is the concern of the Treasury, not the Fed, and Fed officials rarely, if ever, comment on it. If she is asked about the currency wars, she's likely to dismiss the idea, saying that weaker foreign currencies are simply a spillover from valid monetary policies taken to support domestic demand in other countries. Now, insofar as these policies help to revive global growth, they're good for the U.S. too. She can hardly say otherwise, given that the Fed itself ran such a massive quantitative easing program for so long. Now, one thing is certain. Look for more volatility. FOMC days tend to be more volatile than the average day, and FOMC days with a press conference tend to be more volatile than FOMC days without one. So get ready for some big moves. Overnight, the New Zealand dollar was the biggest loser against the dollar among the G10 currencies after the average price for milk at yesterday's auction fell. Still, milk prices are doing better than iron ore. The Australian government overnight cut its outlook for iron ore prices from its December forecast due to weak Chinese demand meeting increased supply. This is causing them to trim their budget forecast too, which means a slightly tighter fiscal policy. I still prefer the Kiwi to the Australian dollar. So this could be a good opportunity to short Aussie Kiwi. Now today's a big day for the UK. The unemployment rate for January and the Bank of England March meeting minutes will be announced. Those are major events for the FX market, but they're likely to be overshadowed by the announcement of the final budget before the May general election. With the vote too close to call, Chancellor Osborne may introduce new fiscal and spending measures in a bid to persuade voters that 5 years of austerity are paying off with an improved economic outlook. That could be supportive for the pound. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.